1. Who can offer these long-term infrastructure bonds? Answer: the entities like LIC, IDFC, IFCI and other NBFCs which are classified as infrastructure finance companies by RBI shall be allowed to issue these long-term infrastructure bonds. Question 2. What is non-convertible debentures? NCD. Answer: non-convertible debentures are unsecured bonds that cannot be converted to company equity or stock. Non-convertible debentures usually have higher interest rates than convertible debentures. A fixed deposit is an arrangement with a bank where a depositor places money in the bank and is paid regular fixed profit. Debentures are long-term financial instruments which acknowledge a debt obligation towards the issuer. Some debentures have a feature of convertibility into shares. Question 3. What is a junk bond? Answer: a junk bond, also known as a high-yield bond or speculative bond, is a bond rated BB or lower because of its high default risk. Junk bonds typically offer interest rates 3 to 4 percentage points higher than safe or government issues. Question 4. What is a callable bond? Answer: callable bonds, also known as redeemable bonds, can be redeemed by the issuer prior to maturity. Usually a premium is paid to the bond owner when the bond is called. The main cause of a call is a decline in interest rates. If interest rates have declined since a company first issued the bonds, it will likely want to refinance this debt at a lower rate. In this case, the company will call its current bonds and reissue new, lower interest bonds to save money. Question 5. Is PAN also mandatory while investing in NCD? Answer: yes. Quoting PAN number in the NCD application form is compulsory irrespective of the amount involved as per SEBI guidelines. Question 6. Can I apply in joint names? Answer: yes. Application can be made in joint names with a maximum of 3 applicants. However, the demat account shall also be held in the joint names and order of applicant shall be the same as appearing in the demat account. In case of application made in joint names, the tax benefit shall only be availed by the first applicant. Question 7. Who would get the interest in case of the joint application of bonds? Answer: in case of joint application, the interest shall be paid to the account of the first applicant only. Question 8. Do we require a demat account for investing in NCDs? Answer: yes, because all the recent issues of NCDs were compulsorily in the dematerialized form. Question 9. What is a convertible bond? Answer: a convertible bond may be redeemed for a predetermined amount of the company's equity at certain times during its life, usually at the discretion of the bondholder. Convertibles are sometimes called CVs. Issuing convertible bonds is one way for a company to minimize negative investor interpretation of its corporate actions. For example, if an already public company chooses to issue stock, the market usually interprets this as a sign that the company's share price. Question 10. Can I get loan on these bonds? Answer: you cannot avail of any loan pledging these bonds in the first 5 years. Thereafter, these bonds may be pledged to avail of loans. Question 11. What are different type of bonds based on their issuers? Answer: different type of bonds based on their issuers is corporate bonds, convertible bonds, callable bonds, term bonds, amortized bonds, adjustment bonds, junk bonds, angel bonds. Question 12. What is the tenure and lock-in period of these tax-free infrastructure bonds? Answer: the tenure of these bonds shall be 10 years and the bonds have a lock-in of 5 years. Question 13. What is an adjustment bond? Answer: issued by a corporation during a restructuring phase, an adjustment bond is given to the bondholders of an outstanding bond issue prior to the restructuring. The debt obligation is consolidated and transferred from the outstanding bond issue to the adjustment bond. This process is effectively recapitalization of the company's outstanding debt obligations, which is accomplished by adjusting the terms such as interest rates and lengths to maturity to increase the likelihood that the company. Question 14. What's the difference between NCDs and FDs? Answer: following are the differences between an NCD and an FD. Liquidity: in contrast to a NCD, FD can't be sold in the market. As NCDs are listed on a stock exchange, you can sell them anytime you want. However, bank FDs are also highly liquid and can be encashed before maturity with minor penal charges. Safety: while NCDs are secured debt, corporate FDs are altogether unsecured and bank FDs are secured to the extent of Rs 1 lakh only. Taxation. Question 15. Can a minor apply for subscription to these bonds? Answer: a minor is not eligible to apply for subscription to these bonds.